Today I'm going to go over Part A of the PeachTree case study for Dr. Shiroki's 139 class at Fresno State. The first question of the case was, why is T-bond return independent from the economy? Well, first of all, it's a bond, so it issues a predetermined coupon. So that coupon, the rate you're going to get from that is going to remain the same no matter what the economy does, except for potentially interest rates. And T-bonds are considered to be risk-free, even though they're not exactly risk-free. The reason they are considered risk-free, though, is because the government's not likely going to go down anytime soon. They're going to be around for a while, and there's a reasonable assumption that they'll be able to repay the debt. And the government controls the printing press, so even if they couldn't pay it, they could always just print more money to cover the cost. Is the one-year T-bond risk-free? Again, this is kind of what I just covered in the first slide. There's no such thing as a risk-free investment. Theoretical default is a risk, but, like I said, I doubt it. There's not a really high chance of that happening. There's inflation risk that would reduce your real return, and then there's also interest rate risk. And right now, it's a terrible time to buy bonds because interest rates are so low, prices are extremely high. If you were to buy, the only place interest rates can go is up. So when interest rates would go up, you'd be locked in at a lower interest rate, and the value of your bond would decrease. Expected returns for different investments. We're going to be looking at the one-year T-bond, TICO, Gold Hill, and an S&P 500 fund. As you can see, the expected return for the T-bond's 8%, TICO's 13.5%, Gold Hill's 8.8%, and the S&P is at 15%. Based solely on expected returns, which of the potential investments appears the best? This is actually a trick question. Depends on the investor risk tolerance and goals, but if you're just going to go for the straight answer, obviously the S&P has the highest return, so it looks the most attractive on the cover. Calculate the standard deviation and coefficient of variation for each alternative. I just put Gold Hill as an example here. There were also graphs for the other investments as well, but I just posted this to show how I did it. And for Gold Hill, the standard deviation is 10.9%, and the coefficient of variation is 1.24. And what risk is being measured with these two risk measurements? Standard deviation expresses how much the actual return deviates from the expected return, from historical prices. The coefficient of variation measures the return per unit of risk. It's similar to the Sharpe ratio. So here I listed the coefficient of variation and the standard deviation of all four investments. I'm not going to read that off to you. How do the alternatives compare when risk is considered? Of course, bonds do the best because they're essentially risk-free. They don't change at all, so they don't have a coefficient of variation to measure up against anything else, and you're going to have constant returns there. So, excluding bonds, though, Gold Hill and TICO are pretty comparable with CVs of 1.24 and 1.23 respectively, while the S&P has the highest risk measured as a coefficient of variation at 1.58. Portfolio. Suppose an investor forms a stock portfolio by investing $10,000 in Gold Hill and $10,000 in TICO. What would be the portfolio's return, standard deviation, and coefficient of variation? Well, I'll tell you. Portfolio expected return and standard deviation of the Gold Hill and TICO balanced asset allocation portfolio. The portfolio return would come to 11.15%. The daunting equation in the middle of the slide is the standard deviation of the portfolio. And I'm not going to run through the whole calculation, but I did come to the standard deviation for the portfolio was 9.85%. And to get the coefficient of variation, simply divide the standard deviation by the expected return, and you get 0.883. The risk reduction is possible in this due to the negative correlation between the stocks. They offset each other, so if one goes up, the other goes down, and vice versa. So you're less likely to have a loss. That's why the coefficient of variation is lower, expressing less risk. So what if we change the allocation? How does that affect the expected return and some different things involved with these portfolios. Well, if we went Gold Hill heavy and we put 75% of our allocation to Gold Hill, 25% to TICO, we'd end up getting a portfolio return of just under 10%. Now, if we went TICO heavy and put it 75% TICO and 25% Gold Hill, we'd end up with a portfolio return, an expected portfolio return of 12.33%. And the effects of allocation change, this is more in-depth, further statistics. Like I said on the previous slide, expected returns. The standard deviation of the Gold Hill heavy portfolio was just under 5%, and the standard deviation of the TICO heavy portfolio was just under 15%. So Gold Hill is obviously much safer, less risky, at least in terms of standard deviation. I like to coefficient of variation as a better measurement of risk because you're looking at risk as a is compared to unit of return. So Gold Hill heavy portfolio has a CV of 0.498, which is pretty safe investment, especially considering that the TICO and Gold Hill individual stocks have coefficient of variations are a little bit over 1.2. The TICO heavy was 1.21. Now, I'll just put the balanced portfolio statistics here to give you a comparison as to how the change affects these two portfolios. So on a balanced portfolio, again, expected returns 11.15, standard deviations 9.85, and the coefficient of variation is 0.883. So the Gold Hill heavy portfolio is much safer, with much less risk, with a slight decrease in expected return, a little bit over 1%, while the TICO has about a 1% increase in expected return, but it's more than twice as risky as the Gold Hill heavy portfolio, although it still is slightly less risky than owning either of the stocks individually. Here comes a new portfolio. What happens if we switch up the S&P 500 fund in place of the Gold Hill stock? So the expected portfolio return on a balanced allocation here would be 14.25%. And will this portfolio have the same risk reduction benefits of diversification as the previous portfolio? I'm going to say no. And the reason for this is the high correlation between TICO and the S&P 500 fund. Negative correlation, pairing negatively correlated stocks in a portfolio is what eliminates or at least reduces risk. So here are the new portfolio statistics using the same methods as I showed in the previous portfolio. Expected return again is 14.25%. The standard deviation sky high 31.5%, and the coefficient of variation is 2.2. The expected return is lower than the S&P 500 fund. The standard deviation and the CV are higher than either one of the individual stocks involved in this portfolio. And again, why is this? Because they have an extremely positive correlation of almost 1. They almost match each other, so it's essentially the same thing as investing in a single stock. So the risk reduction didn't work in this portfolio. So let us ponder here. Suppose an investor starts with a portfolio consisting of one randomly selected stock. What would happen to the portfolio's risk if more and more randomly selected stocks were added? Well, with the diversification, you can eliminate unsystematic risk, as you can see in the graph to the right. The standard deviation returns, which is the risk, as you increase the number of stocks. But as you can see, you can only diversify a certain amount of risk because systematic risk will always exist. So what are the implications for investors? Diversification is absolutely necessary if you're going to be successful in the market, at least long term. You really can't take advantage of price discrepancies in the market. Stock picking is out, portfolios are in, less fluctuation, less debilitating loss, but also less significant gains. Explain the differences between total risk, diversifiable risk, and market risk. Total risk is simply both risks combined, diversifiable and market risk. Diversifiable risk is company specific, as stated in the question. This risk can be eliminated, or at least close to it, with holding a large variety of stocks, some negatively correlated, some positively correlated, and some that aren't correlated at all. you can essentially eliminate diversifiable risk. Market risk, on the other hand, cannot be diversified away. Some market risks include interest rate risk, inflation risk, natural disasters such as the tsunami in Japan. These are the kind of things where no matter what you do, no matter how you position yourself, you still can probably be susceptible to that. Even though inflation, there are ways to protect yourself from inflation. So here's a chart explaining the correlation of all the different investments with the S&P 500. The slope shows correlation with the market, aka beta. These slopes are the betas of each portfolio. As you can see that the S&P 500 has a direct one-to-one slope because their beta is 1. TICO, like we said, has a correlation extremely close to the S&P, and you can see that the slope is slightly less steep than the S&P. Gold Hill is severely negatively correlated with the S&P, and like I said, TICO almost matches the S&P 500 movement. So what is the required rate of return? Is TICO a buy? Should we buy it? Well, the required rate of return is 12.2%. By using CAPM, I was able to calculate that. TICO has an expected return of 13.5%, so buy. The expected return surpasses the required return rate, so basically it just means for the amount of risk you're taking on, it's surpassing your expected returns, or at least your required returns. So how would this react to inflation, market risk, and beta increases? The question posed was what would happen with a 3% increase in expected inflation? Well, real return rates would decline because obviously, the money's worth less than the cash flow you're having come in. And then TICO's required rate of return would increase to 13.4% from 12.2%, because as inflation rises, like I said before, the value of the dollar is less. You're going to need more of them to have the same return. What would happen if the market risk premium increased from 7% to 8%? Increase in risk means an increase in required rate of return. Pretty simple concept there. If you're going to have a more risky investment, you're going to want to have the chance of making more money on it. So the required rate of return would increase from 12.2% to 12.8%. And what if the beta increased from 0.6 to 1 for TICO? TICO's required rate of return would just simply match the market at 15%. If they both have a beta of 1, you're going to have the same required rate of return. The efficient market hypothesis. Weak form states that information is asymmetrical in the markets and that there are large disparities between the intrinsic value of securities and the prices that they are being traded at. Semi-strong form states that information is used fairly efficiently, but there are still opportunities that can be taken advantage of in the market. If you dig deep, you can find some, but for the most part, you're still better off diversifying. And strong form theory states that all information is used completely efficiently, and the price of a stock always accurately reflects the value based on the information available. So as soon as any information is released, it's priced in. That's what the strong form is suggesting. I just want to take a quick minute here to recommend Burton Malkiel's A Random Walk Down Wall Street. I'm sure you've all heard of it, but it goes over all this modern portfolio theory, including efficient market hypothesis, diversification, and all these kind of concepts. So can the efficient market hypothesis be applied to real assets? Simple answer, no, it can't. Real assets vary too significantly to be accurately priced. There aren't enough transactions on a global basis to accurately price these goods either. So, for example, the easiest way to explain it would be the auto market. Not all cars are priced the same because of differences in quality, features, brand. A BMW is not going to cost the same as a Honda. Even identical cars sell for different prices at different locations, which proves that there isn't any market efficiency in the real asset market. So what is the value of a securities analyst, and is it risky to hire one? Well, if the strong market hypothesis is correct, then there would be no discrepancies between price and value on the market. So what would be the point of hiring a securities analyst to try to take advantage of discrepancies? You'd just be losing money. You'd be paying someone to try to find something that doesn't exist. It's a wild goose chase. If there's no edge to gathering information and using it to invest, why would you need a securities analyst? It doesn't make sense. But if the market is semi-strong or weak, it makes sense to hire an analyst to find those investments that are either undervalued or just incorrectly valued. And it seems that the case, a lot of studies have been done, and the market seems to be semi-strong form. So I'd say it still makes sense to hire securities analysts. How would a decreasing long-term debt ratio affect a company if it steadily declined? Risk would decrease because of fewer liabilities, and the lower risk would be reflected in the beta of the stock. A lower beta simply results in a lower cost of capital, and a lower cost of capital results in lower required rate of return, making projects more profitable and companies much better off. Thanks for watching, and don't forget to diversify with Pokemon and Yu-Gi-Oh!